Discretionary versus mechanical management. In our research segments, we have shown multiple times why it is important to manage our trades at 50% profit or 21 DTE. The general idea behind this is that we capture most of the profitability in the first half of a trade, avoid the increased P&L swings in the second half, and increase the number of occurrences through redeployment. But what exactly happens after 21 days in the trade? Why do we roll positions and not hold our losers past 21 days in the hope that they will eventually become winners? This is a very interesting study today because we're going to show you why that can be a very dangerous approach to trading, is hoping that you get that money back. It doesn't always work that way. I was given this talk last night to a small group of traders, and part of it was about what we've learned in the last since we started Tasty. The managing early piece to it, of course, there's the trade small, trade often, and how important law of large numbers and size is with us. But the 21-day piece, the whole managing early, eliminating the outlier risk, putting yourself in mechanically the best position possible is crazy important. Let's go to the next slide. We looked at 16 Delta Strangles, 45 days to expiration, and we looked at the last 19 years. We observed what happens to a 45-day strangle from the 21-day mark to expiration. We compared mechanical and discretionary management. Now, mechanical means close position at 21 days or 50% of max profit. Discretionary means manage mechanically unless the trade is a loser at 21 days. Now, we can't talk about, hey, rolling up the untested side past that because it's too subjective. So we define this as close the position if the P&L becomes positive, or close the position expiration. That's what we're calling discretionary. So it's not like adjusting the position constantly. It's close the position if the P&L becomes positive, or close the position at expiration. You good with that?
Yeah, sure, of course.
The probability of profit is 6% higher as some of the losing trades at 21 days are able to be turned into winners at expiration. So on the surface, it seems that holding to expiration can create more winners. However, the portfolio volatility increases and the unprofitable trade P&L goes more negative. So this is holding 16 Delta Strangles. And as you can see here, there's a lot of information on here. At 45 to 21 days, the average daily P&L as a percent of credit is 1.1%. At 21 days on in is 0.3%. That's enough right there. But if you want to look at the volatility of daily P&L as a percent of credit, it's 34% versus 60. So when you hold past 21 days, not only do you make less money,
it's twice as volatile.
Not only do you make less money, but you per day have your positions twice as volatile. So your probability of profit's still good. It doesn't go down. It actually goes up a little bit because you get some winners back. But the average P&L, the unprofitable trades, as a percent of the credit, goes from 100%, which means you sell something at $1, it becomes $2, to you sell something at $1, okay, and it becomes almost $3.75 or $3.50.
Becomes unbearable.
Yeah. So that's the ugly
really,
part.
when you look at it.
That's the ugly piece to this. Trades that are losers at 21 DT are the culprit of the higher volatility of the second half of the trade, as the trade delta becomes more skewed with losses. So this is why we roll options. It makes sense to redeploy the capital after 21 DT into something more profitable rather than risking an even larger loss if our winner turns into a loser after 21 days. Losers at 21 days, 24% of all trades if you're doing $16 strangles. Losers at 21 DT, winners at 21 DT, 76%. That's fine. When we look at the volatility of the daily P&Ls from 21 days until expiration, you can see here, when you look at the volatility difference between the losers at 21 days, the winners at 21 days, and then the all trades at 21 days, you have to be very careful here if you hold beyond that 21 days. Just the volatility is a creep, and it takes you to an area you don't want to be. It's very difficult to manage.
Agreed. What you had me when you talked about the volatility of the portfolio. I mean, that's when you start getting all the emails from people. That's when you start getting, people worried when their volatility of their portfolio is too great. People don't enjoy the risk, and I don't blame them.
Discretionary management has roughly the same average profit and overall P&L as mechanical management on a trade-by-trade basis. Even though discretionary management has a higher pop compared to the mechanical management, this high pop comes with a trade-off of a significantly larger loss, 6x. So you can see here, the second line is the key. The average loss mechanical, 104%. Average loss discretionary, 666%. That changes the average P&L per trade and obviously the average profit. But it's really just that huge outlier loss that's the killer. We should be clear. It's not the pop. It's not the average daily P&L that much. It's the portfolio volatility, and it's those outlier losses that you can't control by sticking with a position all the way to expiration. This is ultimately why we stick to our 21 DT 50% profit management rule. Although you can theoretically turn some losers into winners by expiration, this is also why we will hold a position that is defined risk at max loss, because that position could come back. But if it's not defined risk at max loss, then we're not going to hold it. And so you can see here on this graph, we have the 1x loser, and then we go to the 6 times loser, which is those outlier losses are killers. They suck down all the other returns, which drives us crazy. So some of the takeaways: the higher P&L volatility we observe in the second half of a trade is caused by the losers that were held past 21 DTE. Even though some of those losers held past 21 DTE did become profitable. Now remember, this study is only on undefined risk. So if you have a defined risk trade and you want to hold that past 21 DT, go ahead if you want to, especially if it's already almost at max loss, because that has a chance to come back and you're not going to lose that much more money. But a trade that has undefined risk, you want to move on from that trade. Total discretionary management losses were less than the mechanical losses. However, they are roughly 6 times larger when they do occur, wiping out the benefits that you receive from more winners. Keep it simple and consistent. Our capital is better deployed, creating more occurrences than hoping that a loser will turn around. And again, this is undefined risk. For defined risk, you can take a little more liberty. But for undefined risk, you're better to redeploy the capital in another trade.
Very good, Sadnov. A great study. We've looked at this a few times, but that was pretty compelling with the volatility of the overall portfolio. That was pretty cool.